What's going on, everyone? Jeremy here from The Quartering. I hope you're having an absolutely wonderful day. Happy Saturday to you. I suppose as long as you don't have money in the Silicon Valley Bank, as many corporations do, perhaps many Chinese corporations, many people are saying it's a pretty interesting story. If you're like me, you're not like super, up to what's going on, how this even happens. How does a bank fail in just 48 hours? Well, I think it's pretty complex, but there's a couple good articles out there that explain it and what it all means. And so this article, we have why did it fail? In short, Silicon Valley Bank encountered a classic run on the bank. Several forces collided to take down the banker. First, there was the Federal Reserve, which began raising interest rates a year ago to tame inflation. The Fed moved aggressively. The higher borrowing costs snapped the momentum of tech stocks that they had before that had benefited Silicon Valley Bank. Higher interest rates also eroded the long value of long-term bonds from Silicon Valley Bank, and other banks gobbled up during the era of ultra-low, near-zero interest rates. SVB's $21 million bond portfolio was yielding an average of 1.79%. The current 10-year Treasury bond is 3.9. At the same time, venture capital began drying up, forcing startups to draw down funds held by SVB. So the bank was sitting on a mountain of unrealized loans in bonds just as the pace of customer withdrawals was escalating. Essentially, they didn't keep enough of their own customers' money in the coffers. That's what happened here. They didn't keep enough of their own customers' money. Like you give me $10 and you say, hold on to it. And then I go spend it a bunch of other places. And then you come back to me and say, hey, can I have my $10 back? And I'll say, well, I only have two of it. It's essentially a super simple way of simplifying it. On Wednesday, the bank announced it had sold a bunch of securities at a loss, and that it would also sell $2.25 billion in new shares to shore up their balance sheet, meaning they were probably at a deficit. That triggered panic among key venture capital firms who reportedly advised companies to withdraw their money from the bank immediately. The bank's stock plummeted on Thursday morning, and the afternoon it was dragging down other bank shares with it as investors began to fear a repeat of the 2007-2008 financial crisis. And we still don't know for a fact that that's not going to happen. By Friday morning, SVB shares were halted, and it had abandoned efforts to quickly raise capital or find a buyer. California regulators intervened, shutting the bank down and placing its receivership under Federal Deposit Insurance Corporation. So the FDIC, that little sign you see. Except the FDIC only insures $250,000, and many corporations had way more than that in the bank. Despite the initial panic on Wall Street, analysts say that SVB's collapse is unlikely to set off the kind of domino effect that gripped the banking industry during the financial crisis. Quote, the system is well capitalized and as liquid as it's ever been, Moody chief economist Mark Zandi said. The banks that are now in trouble are much too small to be a meaningful threat to the broader system. No later than Monday morning, all insured depositors will have full access to their insured deposits, according to FDIC, which is, again, just $250,000 of potentially millions of dollars for each individual company. So while the broader contagion is unlikely, Annie Bonini. Smaller banks that are disproportionately tied to cash-strapped industries like tech and crypto may be in for a rough ride. Senior marketing analyst said, everyone on Wall Street knew that the Fed rate hiking campaign would eventually break something. And right now, that is taking down some small banks. The FDIC typically sells a failed bank's assets to other banks, using the proceeds to repay depositors whose funds weren't insured. Although a buyer could still emerge for SVB, it's far from guaranteed. Some people suggested Elon Musk. I'd rather he just focus on Twitter. But they see there is, in fact, a broader effect happening right now. Stablecoin USDC breaks dollar peg after Firm reveals it has $3.3 billion in SVB exposure, meaning they had that much money with the bank. The U.S. cryptocurrency firm Circle's USD coin lost its dollar peg and fell to a record low Saturday morning after the company revealed it has nearly 8% of its $40 billion in reserves tied up at collapsed lender Silicon Valley Bank. I think this is bigger than most people think. USDC is known as stablecoin, which means the value of virtual currency is supposed to be pegged to as a reference of currency. USDC is designed to trade at $1, but it fell below 87 cents on Saturday. Regulators shuttered SVB Friday and seized its deposits in what became the largest United States banking failure since the 2008 crisis. The company's spectacular implosion late Wednesday, when it surprised investors with news that it needed to raise $2.5 billion to shore up its balance sheet. What followed was the rapid collapse of a highly respected bank that had grown alongside the technology clients. In a tweet Friday, Circle said it had $3.3 billion remaining in reserves of SVB. The company called for the continuity of the bank and said that it will follow guidance from regulators. The crypto industry is still picking up the pieces after the sudden collapse of FTX last year, and USDC's break with the dollar could signal more trouble ahead. Stablecoins, like banks, are also vulnerable to runs. SVB customers withdrew a staggering $42 billion of deposits by the end of Thursday, according to California regulatory filing. By the close of business that day, SVB had a negative cash balance of $958 million, according to filing, and failed to scrounge enough collateral from other sources, meaning they already are $1 billion overdrawn. I have no idea. We have no real idea how much money is left inside this bank. If USDC holders get spooked or worried that there's not enough money in the reserve, they could also rush to sell or exchange their coins. I mean, I think this is far from over. Companies scramble to meet payroll, pay bills after SVB's swift failure. The sudden collapse of Silicon Valley Bank has thousands of tech startups wondering what happens now to their millions of dollars in deposits, money market investments, and outstanding loans. Most importantly, they're trying to figure out how to pay their employees. That's question number one. SVB is a 40-year-old bank that's known for handling deposits and loans for thousands of tech startups in Silicon Valley and beyond. It fell apart this week and was shut down by regulators. While the bank's failures aren't entirely uncommon, SVB is a unique beast. It was the 16th biggest bank by assets by the end of 2022, according to the Federal Reserve, with $209 billion in assets. Unlike a typical brick-and-mortar bank, though, SVB was designed to serve businesses, with over half of its loans to venture funds and private equity firms and 9% to early-stage and growth-stage companies. This is the thing. The FDIC Corporation, which became the receiver of SVB, insures $250,000 of deposits per client. Now imagine if you had like 40 million in there. As of December, roughly 95% of SVB's deposits were uninsured, according to filings with the SEC. 95% uninsured. Yikes. Now, of course, as the FDIC sells the assets of Silicon Valley Bank, future dividend payments may be made to uninsured depositors, but who knows how much money you're going to get back. And companies that have big, loans and things like that tied with this bank, more than 85% of Silicon Valley Bank's deposits were not insured. Here's what that means for customers. Many Silicon Valley startups had millions or even hundreds of millions of dollars deposited at the bank. Money they use to run their companies, pay their employees. Right now, nobody is sure how much cash is even left. Yikes. I mean, this is going to be a year of realignment, coming back down to earth. That's what we're seeing in the tech industry, with huge layoffs basically constantly coming down the pipe from tech companies, Facebook, Twitter, Google, YouTube. All these companies are going to be have been laying off tens of thousands of people. Of course, the Silicon Valley Bank CEO sold $3.5 million in shares just 2 weeks before the collapse. I'm sure he knew nothing about it. I'm sure he saw none of it coming. I'm sure this is all a surprise to him too. I mean, this is an absolute, I mean, there is going to be a massive ripple effect here. This is the very same guy who pressed Congress to weaken risk regulations. But hey, Elon Musk shows interest in buying Silicon Valley Bank after collapse. I mean, Elon Musk tweeted about it. I'm not sure that's interest, although he did tweet about buying Twitter, and he did eventually do that. I'm not sure he has the money to be buying it. He's open to the idea is basically all he said. Make it a digital bank. This is going to have a massive ripple effect on Silicon Valley and big tech, and we'll find out in the future, like which companies have huge money in SVB right now. We don't know for sure. I mean, they will, obviously, if they're publicly traded, they're going to have to disclose this. But yikes, second biggest bank collapse in history. And it happened in just 48 hours. Keep some cash around the house, I suppose, boys and girls. I hope you enjoyed this video. I hope you were educated a little bit by it, entertained by it. I'd be looking forward to reading all your comments in the comment section down below. Don't forget to subscribe before you leave, and we'll talk to you again real soon.